All right, so we had a really, really rocky week in the markets this past week. A lot of stuff happening. We had bank earnings, we had the CPI and PPI come out, and then I guess this was on Saturday, so it hasn't really shown what's exactly going to happen, but we have Iran bombing Israel. So it's going to be very interesting to see what's going to happen going forward. We had, as far as the markets go, we had the S&P was down 1.62%, the NASDAQ down 1.46%. So I think it's looking like the markets have peaked, and it's looking like we're going to see a pullback here. And nobody knows how deep it's going to be, and nobody knows even if it's going to be a pullback. For all we know, we have an amazing earnings report or earnings season. We have the next inflation print is down significantly, and we're off to the races. Nobody knows, but I think the data points towards we're going to see a pullback, but I don't think it's going to be major, unless there's a couple things that could cause that. Not only inflation staying sticky, but even more sticky than the people that are pointing out that it's sticky are thinking. The other thing, too, is that if this Israel situation escalates significantly, or the Russia situation, but they are somewhat intertwined, because Russia is going to be backing Iran, and the States are typically with Israel. So that's, again, there could easily be a black swan, or even, I don't even know if you'd call that a black swan, because it wouldn't be surprising, especially with the kinds of people that are in charge of a lot of these Western countries nowadays, but that's a different story in and of itself. So again, that's just my opinion here. I think we probably pull back 5-10%, probably in the mid to high 4,000s on the S&P. As far as earnings go, again, the banks, we are back into earnings season, which is, again, going to be interesting to see. So again, the big banks always lead. They're always that first week. And JP Morgan and Bank of America, again, very similar story here. Revenue, they beat. Earnings per share, they beat. But net interest income, they were off by a little bit. And that plays into the problem of rates being higher for longer, number one, and higher than even expected right now. If you look at the 10-year, I think was bordering on 5%. I think it closed around 4.5, 4.5, 4.6, which again is higher than what we were expecting. So the rates being higher than expected, that's something that's definitely coming into play here, and that's something that definitely is a concern going forward. But getting into this tweet here, if it would load. So we have Joseph Wang, again, who's a good follow on Twitter. He used to work for the Fed. So again, not only does he have, I don't know if I'd call it insider knowledge because he doesn't work there anymore. He understands how the system works very, very well. And to be frank, his book, Central Banking 101, was honestly probably where the majority of my knowledge on the intertwines of the system came from. So anyway, he says, yes, transitory and seasonal were wrong, but that misses the point. These guys are doves and they'll find a reason to cut rates. So I think this is very telling here because, again, this is a guy that worked for the Fed. He understands the system as good as anyone, and he probably still knows people there. And again, he knows this stuff as good as anyone. So frankly, that's pretty much my hypothesis, is that, transitory and seasonal and this idea we're going to see all these massive cuts probably wasn't the case. In fact, it isn't the case. Let's be frank. But again, at the end of the day, there is no way that rates can stay this high for the long term. At least I wouldn't say no way. Extremely unlikely. I mean, you look at the interest on the debt, I think within the next year is going to be over $1 trillion a year. And again, that's going to be compounding at whatever, 5-6% per year, 7% per year. Like there's no way that can be maintained. I mean, it can be maintained, but it's just going to cause potential major problems. Not only that, it could cause problems with the banking system as well. So I think we're going to see cuts. It's just a matter of when and how much. And the question is that I think that eventually they're going to get to the point to where it's like we could see a major crash or a major problem in the banking system if we don't cut. And again, I think that's going to happen later than what is even expected now. It might not be till the end of the year, maybe even early next year. That's definitely possible. But I think I still would be very surprised if we don't see cuts in the next year. Very surprised. And again, that's going off my research, and that's going off people like Joseph's research here. Again, I really respect the guy. I think he does a very good job. So the last thing I wanted to touch on here again is the portfolio. Again, has taken a bit of a hit recently, mainly due to rates. But again, I think the play here is still quite obvious, in my opinion, in that you're not too aggressive right now, because I think that we're talking probably 70-80% of stocks are overvalued. The majority, I think, are very clearly overvalued, and I don't think you want to be too aggressive. My position has been, I think that once the S&P, assuming it does, which again, there's no guarantee, don't get me wrong here, once the S&P pulls back to 5,000 or a little below 5,000, I think you're going to start to see some deals. And then if it pulls back even further, you're going to see definitely a good amount of deals. If it goes down to like 45, 46, even 47 probably, I think you're going to see a lot of deals in the market. So if we get a major, and again, the last thing I want to touch on here, actually there's one more thing too. One other thing I want to touch on is do not fear pullbacks. Pullbacks are a good thing. Number one, because it rids the market of the weak hands and the people that are just way too aggressive. And on top of that, it provides the opportunity to get deals. Again, this is investing 101 here. Do not fear pullbacks. In fact, embrace them, because it just gives you a chance to get good companies at a discount. So again, bring it on. Let's pull back into the mid to high 4,000s. Like it won't bother me at all. And again, it shouldn't bother you, because number one, that's how the markets have always worked, right? And number two, if you're a long-term investor, you don't care. You don't care. I mean, if you're investing for 10, 20, 30 years down the road, who cares if we get a 10 or 20% pullback? Like, you're not going to care. You're not like the only reason you're going to care is if you're investing in a stupid way. You're overly aggressive. You're investing in poor companies, et cetera, et cetera. And again, the last thing I wanted to touch on here is Bitcoin. Bitcoin got hit really hard with this whole Iran-Israel situation, which to me makes zero sense. I think the reason that it happens typically is when these kinds of things happen, there's typically a flight to quote-unquote safety. There's many problems with that hypothesis. Number one, Bitcoin is safety. Not enough people have figured this out yet. And number two, what is considered quote-unquote safe isn't, I mean, usually it's the dollar, it's gold. Although gold usually just does good off the start, and then people have to sell because they need liquidity. But I think that the only real reason, to be honest, is if you need liquidity. That's really the only reason you should be selling Bitcoin, in my opinion. There's I don't care what, literally Russia could bomb Washington or vice versa tomorrow, and the thought wouldn't even cross my mind to sell any Bitcoin. So, and again, if that's the case, you're probably too over-levered. And I've said time and time again, as bullish as I am, you don't want to be using leverage. You don't want to be using money that you can't afford to lose, et cetera, et cetera. So I don't think that this situation is going to be that major. But again, we do have idiots running our governments. I wouldn't put it past them. But I think that cooler heads will prevail. And I mean, again, this kind of stuff is not completely out of the ordinary either. I mean, when has the Middle East ever been at peace going back 50, 100 years? It's never really happened. And again, I'm not saying I don't want it, right? I'm not putting it like that. But why is this something that we're so scared of in the West? The only reason that we would be scared of it is if we're going to do something stupid and get ourselves involved in a battle that we have no skin in the game in. But again, that's also a different story in and of itself. So again, my predictions going forward, I think we see a pullback over the next month, 2 months, 3 months, for sure by the summer. That would be my deadline. I think if we get through the summer and the S&P has still stayed above 5,000, I think it probably smooth sailing, depending on the inflation numbers, obviously. But that's my projection. I think we see, I would say, a pullback of around 10%, give or take, maybe 5% either way. And the Fed probably cuts within the next 6 months, I would project. For sure by the end of the year. I would still be very surprised, although it's probably not going to be it's for sure not going to be the 6 cuts that were expected. I think the market's still pricing in, 2.5. That might even be aggressive, but I would be surprised if we don't get cuts. Because, again, like Joseph Wang said, at the end of the day, these guys are doves. At least most of them. And I think that, again, a lot of people say, oh, well, he wants to be remembered as Paul Volcker, like, Jerome Powell. But you're also forgetting the fact that, number one, 99% of people do not know who Paul Volcker or Ben Bernanke or any of these guys are. But they do remember what happened in 2008, or what, if you're alive in the 80s, you remember that. But you don't remember who the Fed chair was. I think that's kind of a dumb argument, personally. And again, eventually I think it gets to the point to where the bigger risk is not inflation, but rather the potential damage to the banking system and or the real estate market, the banking system, the stock market. I think that probably will be the bigger concern. And again, not only that, the fact that how do we keep putting off this debt situation? I think that eventually that becomes a bigger concern than inflation being at 3%. Not that that isn't an issue, because that's a huge issue. But I think that there's going to be too much push in the other direction. So anyway, that's what I wanted to bring up today. If you liked the video, please like, subscribe, comment, all that good stuff, and stay tuned for more.